But I can tell you the ones that succeed are the ones that go in with intention and they plan for the negative. What I would say to anybody contemplating getting into acquisition, if it's not something they normally do, is when you go into an acquisition, establish your intention. What is it that you want to accomplish immediately? What do you want to accomplish in the short term and the medium term? And what's your long-term objective for this acquisition? Because otherwise, I think you're going to find out that what you wait to find out may not play out the way you want to or in your favor. The other part is planning. You're actually trying to figure out what this business is going to look like in the aftermath of the closing. There are integration issues. How is it going to integrate with your current structure? There are planning and budgeting issues. What is the budget? What is the expectation? That's equally important because your banks might have lent money to you on the basis of forecasts, and it's equally important because you may have to get approval of the budgets that are associated with the acquisitions. So your due diligence is where you do all of that. You do your planning and you do what is called a post-acquisition implementation plan if you really do have intent, which I spoke about earlier, and you at the very least have to do the verification side of things. There are two purposes of due diligence. The first purpose of due diligence is the obvious one, to verify what the seller told you that led you up to leading to a purchase price. The verification stage is where you talk about the legal assertions that were made. Do we own what we say we own? Is there what we call warts on the corporation that you're buying? So are there liens? Are there related tax impositions or any other thing that's associated with the legal entity that you're buying? Those are much more about verification. Then there's the second element of verification is the numbers. It's not quite an audit, but you're going through the numbers that were presented to you and making sure that they make sense. In some cases, you do a full-blown, what they call a quality of earnings. In other cases, you just bring your financial people in to run analyses on the numbers. The biggest pitfalls are the unknowns. I did a conversation in one of my previous things where I talked about fail fast. Well, the pitfalls are you've got to make the decisions and come up with the situations, identify them, and solve them fast. Because the faster you identify the situation, the better the chance you have of mitigating against the negative or adverse outcome of that situation. And the common pitfalls are that you miss or underestimate the impact on the employees, and then you have a significant exit of employees from the organization. The client side of things is also a common pitfall. You underestimate how much client attrition there might be associated with the merger of two entities. It's less common, but certainly given larger sized acquisitions, there really is a real statutory or legal or regulatory pitfall that you would better be mindful of. If you don't contemplate the competitive landscape and what the regulators might think about that, you might find yourself in trouble. And executives, which is a real concern, is brain drain. So I talk about employee flight, but it's an even bigger pitfall if it's executive flight. Know who you want to keep on your management team, know who's important, and if necessary, bake it into your acquisition agreement. The wait and see attitude is an attitude that often leads to trouble. Because in a wait and see attitude, you might have issues like severance considerations. You might have issues like union considerations. You might have issues like the morale or the fit between the acquiring entity and the bought entity. So the planning side of things is where you actually run scenarios. What does it look like post-acquisition? How does the union relationship in company A compare to the union or labor relationship in company B? What are the potential terminations, or what's the expected continuity of employment? What is going to happen to the client reaction? Quite often situations where companies will say, I was fine with two separate entities, but when you bring them under one roof, there are considerations for your clients. There might be statutory considerations or legal considerations around competition. If you don't do a proper post-acquisition implementation plan and instead you do a wait and see, history tells me that can be very costly. There are different elements to an acquisition that one has to consider at various stages leading up to an acquisition. So for example, there's the accounting side of things, which is your day-to-day activity. And quite often, again, people are starting to deal with that post-acquisition, sort of saying we'll deal with it after closing. The reality is you should be lining up the accounting, particularly if you're a multiple entity organization, to ensure that the accounting associated with what you're buying can feed into the reporting of what you already own. The other things you got to consider are just the day-to-day activities, banking, credit cards. What happens and how do you ensure that the deposits go to where they're supposed to go to? How do you ensure that you're able to write a check the day after you close? And those things have to happen at least a few weeks before closing because it takes time for the banks to do what they need to do. I've had acquisitions where we've sort of said to clients, listen, we better start figuring out our banking. For example, something as simple as opening the bank accounts and ordering the checks. And they're like, well, we can't do that until we close. And I say, okay. And then the day after close, you got to pay the rent. The day after close, you're wondering, where are my deposits? Well, your deposits are going into the seller's bank accounts because that's where they've historically gone. And so you've got to think about these things before you close. You've got to be aware that you're running a business the day after closing. Plan, 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 and intention. Understand why you're buying this business, what you expect to achieve by buying this business, and what you'll do if those things don't pan out. Have intention. If you go into a transaction without intention, I've seen many of those transactions fail. When I started doing acquisitions I'm embarrassed, 35 years ago, I will tell you that they said at those times 85% of acquisitions fail. Today, I think it's probably a lesser number, but I'll bet you it's still greater than 50%. But I can tell you the ones that succeed are the ones that go in with intention and they plan for the negative.